and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. I'm pleased to welcome back two of our regular guests, John Ciampaglia at Sprott Asset Management and Per Jander from WMC. John and Per, thank you for joining me today on Sprott Radio.
Great to be back.
Yeah, thanks, Ed. Thanks.
Well, gentlemen, I know, Per, pretty much every time I speak to you, you're somewhere else in the world. And this last week, you were down in my neck of the woods, down in Florida at the BMO conference. And John, you were down there as well. And so I thought it would be really interesting for our listeners to get a general idea of some of the themes, topics that were really being talked about and what the enthusiasm level was as relates to mining in general. John, let's start with you. What were some of the general themes that you were impressed by or taken back by as relates to BMO last week?
Sure. And for those that don't know, what Ed is referring to is the Bank of Montreal. It is their mining and critical materials conference, which they've held for many, many years. It's one of the largest in the world. It's about 2,000 participants and draws institutional investors from around the world. And over the 2.5 days that our team was there, I think we had about 40 meetings with different institutions. So my first comment is that interest in mining globally remains very high, hence the very high attendance. And I actually heard there were 400 people on the wait list to attend the conference. So really strong interest in mining. And this was obviously not the case. This was not drawing the same amount of institutional investors even 3 or 4 years ago. So I'd say that's probably a really strong and supportive sign. This year, the theme of the conference, I would say, was really kind of the renewed interest in gold. And the last 2 years, I would say, was kind of in the shadow of other things like lithium and copper and uranium. And this year, with gold hitting all-time highs in US dollars, is obviously captured a lot more attention. So that was very positive because I think many of the gold miners that have been in attendance the last 2 years were kind of struggling to generate interest in their space. Naturally, the conversation crossed a number of metals given the renewed interest in gold and how much Sprott manages in that category. The general, I would say, theme related to many commodities on the industrial side, including uranium, is one of uncertainty in terms of what is going on. There's a lot of obviously political, geopolitical factors affecting these markets. It's uranium, it's copper, it's steel, it's aluminum, and they're obviously getting entangled in a lot of different items, everything from the threat of tariffs, retaliatory export taxes, lots of changes to the Inflation Reduction Act and the Loans Program Office in the United States, which is, I think, giving utilities another reason to kind of pause. And then there's lots of chatter about, how the relationships between Russia and the United States may be evolving and how that may be affecting critical markets like uranium. So a lot of questions and unfortunately a lot of uncertainty. And, with uncertainty, I always say it's worse than bad news. It just kind of paralyzes market participants. And that's what it feels like we're in right now, a state of sitting on the sidelines waiting for more clarity.
That uncertainty, is that, in your mind, kind of what's driving maybe gold over and above, say, central banks, buying? Is that putting wind in the sails?
Yeah, I think it's a really good point. If you think about gold, hitting all-time highs in US dollars, we like to think of gold as a safe haven asset, given how it has historically performed in different turbulent market situations. The parallel we like to think about is almost like paying an insurance premium. And so if you think the risk of something happening is going up, you'd be willing to pay a higher premium for that protection. That feels to us as one of the key drivers of why gold is going up. Market participants are obviously reassessing a lot of these geopolitical factors, the uncertainty related, the impact it may have on a number of different asset classes. And people are thinking, obviously, much more cautiously about equity markets, bond markets, currency markets, commodity markets. And we think that's one of many drivers helping to support the price of gold.
And Per, let's bring you into this on the uranium front. You spent a lot of time globally looking at and acquiring and helping Sprott along the way with uranium. Is that uncertainty filtering into the uranium markets? What's going on? Or I guess maybe help the listeners understand the difference really between what's happening in the spot market today versus the term market, and walk us through that as well.
It certainly is affecting uranium in a very big way because I think few fields are as like dependent on geopolitics as the nuclear fuel cycle and the nuclear fuel industry, because it is so globally connected. It mines in one part of the world, it's converted in one part, and then it's enriched somewhere and it's put into fuel bundle. There's a lot of logistics going on there, and it's clearly being heavily affected by all these recent developments from a geopolitical standpoint. And a good place to start is just to point out that there's a lot of talk of Russian uranium, and it's while there is such a thing as Russian uranium, it's Russian enriched uranium, because Russia is not even self-sufficient when it comes to the natural uranium, the stuff you get out of the ground. So they need to import that in order to have feed for their conversion service facilities and their enrichment facilities. Russia provides a lot of conversion and enrichment to the world, and that's where the focus obviously went. Whenever there's a certainty about the supply from Russia, that's where utilities are going to focus, and that's where they have focused over the last few years. And there's so much uncertainty around the Russian products going to flow. Are they not going to flow? So if you're a utility, you run to kind of cover yourself in that area, and then you worry about the uranium concentrate, the U3O8 aspect at a later stage. And if we just look at price development, it's conversion and enrichment has gone 4 or 5x over the last few years, and those prices are not really coming down. And whereas uranium is at these levels, at least the spot price, we're probably not that far above where we started when the war broke out. It really has been a lot of volatility, but the volatility in the spot market is more dependent on the lack of buyer activity, whether that is from utilities who, to John's point, are simply just staying on the sidelines right now because there is so much uncertainty. You just want the smoke to clear, essentially, but then it keeps getting more smoke. It's like someone in the White House has a bit of a smoke machine right now. Now, hopefully that's going to clear at some point, but I also think it's a conscious effort to kind of, disturb the playing field a little bit and set the stage for negotiations that are going to happen in the next few months here. You look at the term price itself, it's gone nothing but up or held firm, at least. Sure, it's gone down $1 or so maybe because of a junior miner who probably doesn't even have a operating mine that felt like they had to drop their prices a little bit to get a contract over the line. But overall, the term prices has gone nothing but up and is currently holding firm. And you look at the spot price at 65, now we have a spread of $15. That clearly is in the realm of where you can make a carry trade work. So you buy in the spot market, you finance the material, and you sell it to utility further out in time. So now you're starting to see a connection between the term price and the spot price. And as the term price is holding firm at $80, that means that the pressure is going to come to the spot price, and it has started. We've seen at least a stop in the fall of the spot price. It's kind of holding firm at 65 now, and there's been a bunch of transactions there, and I would not at all be surprised. But sure, while I hope, but I also honestly think that prices will turn around in the coming weeks.
That's good insight, and you would think that with everything that's going on from an uncertainty standpoint, the price would actually be going higher. It seems a bit confusing to a lot of our investors. The long-term story for uranium has only gotten better, yet the supply side is getting more constrained. Help us make sense of that, because that seems to be a confusing thing for a lot of our investors right now. They buy into the supply-demand dynamics, and the supply is getting constrained, but the price isn't reflected in that. So what's going on with that?
I think one aspect that people tend to forget about anyway, and it's a very unique aspect for the nuclear fuel industry in itself, is that the lead times are very long. When you buy uranium, you take delivery a year out, maybe even, but that uranium that you take delivery of is not going into your reactor for another 3-4 years, right? So there's a lot of inertia in the flow of nuclear fuel from the miner by the time it gets into the reactor, and that automatically gives the fuel buyers some time. So they're very rarely pushed into a corner. Now, overall, well, not all fuel buyers act the same. The situations are all different from the various utilities. But as an overall trend, they normally have a little bit of time. Now, they can't wait forever, and we haven't been in replacement rate contracting for a very long time now. So clearly, at some point, that time is going to run out. But they do have a little bit of time. So for right now, they don't have to rush to the market. They can kind of sit back and wait things out. They're not extremely price sensitive. Now, by all means, I'm not saying that they don't care if uranium goes up or down $20. Of course they do. but at the bottom line of their operations, it's not going to be that heavily affected because the portion of uranium in operating cost is so small that it's not going to cost you to shut off your reactor just because uranium prices go up a little bit. So those two factors, I would say, are the main reasons why utilities can afford to wait a little bit. They don't have to catch the absolute bottom. And it's more to John's point, uncertainty is worse than actually bad news. So they just want some kind of certainty, and then I'm pretty sure we'll see a few of them spring into action.
Thank you. And John, are you seeing anything, or is there any additional color you can add to that? Because you sort of sit on a different side of the table as far as the types of investors you're talking to. What's the general feeling out there right now?
I would say the general feeling right now is one of frustration because people are looking at the longer term supply demand fundamentals and they're saying it has only strengthened over the last 12 months. So how do we make sense of, I think, two key dynamics they're focused on? One is why have the utilities kind of dragged their feet on getting back to replacement rate contracting, given all the positive momentum around nuclear renaissance. Obviously, the new Energy Secretary in the United States has done multiple interviews publicly saying this nuclear renaissance is a priority for me and President Trump and this administration. So the term price, as Per said, I mean, it went up about 20% last year. So that's a very positive signal. The contracting didn't quite match as utilities kind of balked at the high prices and then got distracted with other things. And then, on the spot price, which again gives us a very different price signal, it's been very volatile. I mean, last year, over the course of 2024, we probably averaged about, I think, $85 per pound. But we ended the year around 70 and now we're sitting at 65. And so people are saying, well, what signal is that sending me right now? And I think our message is it's sending a lot of noise, that the differential between the spot and the term price to us seems out of whack. And I thought it was really interesting. One of our longtime institutional uranium investors in one of our meetings at the conference last week said, for a market that's in a structural supply deficit state like uranium is right now, the fact that term is $15 a pound more than spot didn't make any sense to them. And we would totally agree with them. What's happening is people are fixated on the spot price, trying to decipher what signal that is sending. Is it a real signal or is it noise? And one of the things we've been talking about last week at the conference is a factor that we think exacerbated some of the downward selling pressure in the spot market. And that is our belief, we can't completely confirm it, but our belief that there was a Kazakh domiciled physical uranium fund that went through a liquidation process in the end of last year and perhaps even into this year. And this was a state-sponsored fund that was created a few years ago. The strategic objectives of the fund no longer applied, and we believe that a little over 2 million pounds was cleared through the spot market. That clearly weighed on the market, as the market knew it was coming. It happened at a period of time where markets are generally less liquid. And then the other thing I would say is if you think about, the point I made earlier about the spot price averaging about $85 last year, what's kind of interesting is you have to think about the incentive that participants have to buy at $85. So if you think about producers, which traditionally would always come into the spot market to kind of backfill some of their inventory, what incentive would they have to deliver uranium at $60 and buy it in the spot market at $85? The answer obviously is none. So they were very quiet last year, and we just got the numbers from one of the trade publications that indicated that producers bought 1.9 million pounds in the spot market last year. Now, for context, they bought 6.9 million pounds the prior year and 10.9 million pounds the year before. So the producers kind of disappeared as the spot price raced ahead of term. And then if you think about utilities, obviously they weren't buying material in the term market. They obviously have very little incentive to buy in the spot market because of the way they contract. There is no urgency there. So we think we saw, at least two of those market participants step away due to high prices last year. And financial players, I would say, were less active last year. So in the absence of having those buying groups, and a bunch of material hitting the market, I guess in hindsight, I'm not totally surprised that the price was a little soft, in the fourth quarter and at the beginning of this year.
Any conversations around copper? So you're seeing more things happen in the copper market. More people are talking about it. Was this mostly a gold and uranium narrative at the most recent conference, or was copper part of that conversation as well?
Yeah, it's interesting because at the conference, they do an institutional poll and they ask all the participants, what metals are you the most bullish about in the next 12 months? And interesting, the results from the poll was split evenly between gold and copper. So obviously we talked a little bit about gold and its, I think, bullish dynamics that are playing out right now. But copper, even though the price has kind of meandered around a little bit, people remain constructive. And I think the reason for that is that people are looking at more of the medium and long-term dynamics as opposed to the short-term noise and saying that the fundamentals for copper remain incredibly robust, given many believe we will have a supply deficit in the next 1 to 2 years. So I think many people realize that this whole energy addition that, we often talk about, this incredible need for more electricity, not just from emerging economies, but from developed economies. Copper is really the key metal. Anything to do with electrification and moving electrons, copper is the go-to. So I think copper is remaining resilient, even though it is getting kind of entangled in all of the threats of tariffs. The Chinese economy has been kind of mixed, but copper, I think, medium to long term has a very strong story intact.
Actually, I can kind of chime in on that too, because normally I'm not the copper expert, of course, but I actually went straight from Florida up to PDAC. So I'm in Toronto right now, and I was speaking at a session yesterday on uranium, but it was also a lot of copper of gold discussions there as well. And one of the speakers was Mike Henry at BHP, and again, I don't listen to copper presentations that often, but he said something that resonated with me. With 70% demand increase by 2050, and in the next 5 years, he said there is $250 billion of investments needed just in the upstream alone. So there is an enormous amount of investments, and obviously BHP is doing what they can, but there's really a call to power everywhere that, considering where this society is going, and just not for AI purposes, whatever, but electrification everywhere, there is an insane amount of demand for copper. So they actually had a very similar poll asking a room of maybe 500 people what they thought about the next 12 months when it came to copper, gold, and uranium prices. And there, I think it was more 60% was on copper and about 20 or so on gold, and those were the two leaders at least. So clearly a lot of belief in copper, no doubt.
Yeah, I read something recently. No matter how you're producing energy, you need the copper, period. Whether it's wind, solar, nuclear, oil and gas, coal, it doesn't matter. Copper has got to be part of that. And that 70% increase in demand by 2050, that's a staggering stat. Let's shift gears a little bit. We're talking a lot about the physical metals right now, and I think that really drives most narratives. But the miners are starting to get a little bit of love, and I say that because they've been unloved for a while. There's been a big disconnect for a long time. John, let's start with you and talk about miners in general on the precious metal side. What's happening on that side right now? What's the theme?
Yeah, I'd say the theme is improving sentiment, and that's really positive because last year it was a mixed sentiment. And the reason for that is that you had an incredibly strong year last year for the price of gold, but very mixed results in terms of the gold stocks. And I think what really, was an overhang on the market was the two largest miners in the world, Newmont and Barrick, last year. Their stocks really underperformed the price of gold. And you would expect when the price of gold is up 25% that those stocks should do really well. They did not. They really underperformed. And they underperformed for obviously very, company-specific reasons, whether it was geopolitical issues at Barrick, cost-related issues at Newmont, and the market really expressed their displeasure with those two companies not providing the operating leverage you would expect them to. I'd say that the sentiment is starting to change. I think some of the issues they were facing last year are becoming better in terms of the outlooks, and we have seen much better performance of the gold stocks relative to the metal. And this is the big challenge for these gold stocks is they need to deliver that operating leverage, because what's the reason to invest in them if they don't? And that's the big challenge. It's the path of least resistance is to own physical gold, and so there's a real big challenge and opportunity here for these gold mining companies and silver mining companies to deliver better results. And so far, investors are responding to the current messages and outlooks that they're sending. There's going to be a bit of a lag effect, but we definitely had conversations with many institutional investors at the conference that they're thinking not just about physical gold, but they're also thinking about the related equities. So I think that's a good sign. But I think some of these gold stocks right now are kind of in the, show me, prove it to me camp. But sentiment is clearly improved and relative performance has improved. On the critical mineral side, obviously the equities have struggled. The uranium stocks in the last few months have really come off with the slowdown or the uncertainty that's kind of strangling the uranium market. Same thing with copper. Everybody's waiting to see how exactly these businesses and these business models are going to be impacted if there's a 10 or 25% import tariff. That could have a meaningful impact, and we've seen it playing out in the physical market. There is a rush going on right now to transport some of these physical metals from Europe or Asia into the United States ahead of potential tariffs. That is obviously creating a big distraction and an arbitrage that people are trying to capitalize on. Some of these stocks, as you would expect, they have been performing alongside the underlying commodity prices, which have been soft.
We haven't talked a lot about silver. And silver seems to be sort of stuck between the monetary side of things with gold, but also the critical material side as it's used in more and more things like solar and whatnot. Anybody talking about silver at all as it relates to the physical and the miners?
Yeah, I think most investors, I'll start off with institutional ones anyway, they're obviously captivated by gold right now just because of the unique attributes it could play in their portfolio in terms of risk management against some of these risks we talked about earlier. But obviously, there is a link between gold and silver, and that gold-silver ratio right now is very high, meaning, silver has lagged. It has not kept pace with the appreciation of gold, and I often remind people that it's one of the few commodities that is still very far away from its all-time high, which is well over a decade ago. So silver has a lot of catch-up in our minds to play. What is not propelling it higher is obviously its dual purpose of being a monetary and hybrid metal, but it feels incredibly cheap to us relative to gold. I mean, one of the things that is holding silver back is you don't have the central bank buying like you do with gold. And that is a big buying group. Now, what you have in silver's favor is obviously a big buyer group of industrial users, things like solar and electronics and all that. So it's kind of like the industrial against the central banks. That's the big delta around the different buying tension. And unfortunately, right now, it feels like silver is getting weighed down like copper and uranium and in terms of its industrial qualities.
For our listeners, they're listening to your comments and thinking, okay, how can I participate as an investor? And do I just stick with physical and kind of ignore the miners in general? Or is there actually finally an opportunity for these miners to do quite well going forward?
On the mining side, putting aside who's paying more for tariffs, the prices right now are quite attractive. And it feels to us as though a lot of the cost inflation that these mining companies have endured over the last few years is kind of starting to stabilize. So that's when you would expect higher commodity prices to be able to trickle down to their bottom lines. And that's the opportunity that the miners obviously provide, is, that operating leverage lift that they historically have provided against the physical commodities themselves. Sentiment around the miners seems to be better, perhaps less sensitive to some of the geopolitical tariff talk, because at the end of the day, the miners aren't taking a discount for the metal they're selling. It's the buyer who's going to be paying more for the metals.
Let's think of that from an investor standpoint then. Let's just use an example. You got $100,000 to invest in the market. You're going to put maybe 10% in precious metals. A, to help offset some volatility, and then B, to be opportunistic about growth potentials in the miners. Again, we're not recommending this in any way, shape, or form, but how should someone think about that? Is it a simple 50-50 split, half your money in physical, half your money in equities or miners? Or, how should you be thinking about that from an investor's point of view?
It's a really good question, and it's obviously a challenging question to answer because it's not a one-size-fits-all answer. At the end of the day, equities are equities, even if you're a gold equity. And if a broader equity market sells off, what we've seen historically is, gold stocks will go with it. And in the short term, even physical gold will go with it. But I think it is kind of interesting to think about allocating some percentage of your overall precious metals weight to the equities right now, which I think look much more attractive from a valuation perspective, from a cost structure perspective. Things seem to be leveling out, which is very important. And so it does feel as though that risk reward looks more favorable than it did, say, 12 months ago, when I think some of these gold mining stocks were still struggling with some cost overruns and overall inflation in their supply chains.
So I always like to say physical first, equity sort of second, as far as how you think about portfolios. Is that fair to say then?
Yeah, I like to think of it as a pyramid where the physical gold is at the base. It forms the foundation. As you move up the pyramid to the point, then you can get more creative with equity exposures, whether it's all cap, large cap, small cap, or whatever. The fundamental is the physical, because it provides your portfolio with the most unique diversification attributes relative to other asset classes. And I think that's why gold has stood the test of time, why it's been considered a store of value for millennia, and why it will continue to play an important role in an overall diversified portfolio.
Yeah, well said. And Per, on the critical material side, specifically uranium, how should investors be thinking about that? You'd mentioned, at $65 a pound, a lot of these miners probably not getting paid appropriately to pull it out of the ground. So how should investors think about the physical side from an investor standpoint relative to the miners?
Looking at uranium alone, on just where the spot price is right now, I'll preface it with that I've always said it before, at higher levels too, I didn't see much downside, and here we are lower anyway, but I think we've talked about some of the reasons of lack of buyers, and certainly from both producers and utilities, and one-offs like the liquidation of funds, that it just feels like $65 is not sustainable. So whether you go into the miners themselves or the physical, I would say the outlook is more or less the same. Could it be more leverage on the miners? For sure, because they are riskier, just like John just pointed out. I talked to one investor who's been around for a long time. He just looks at it like it feels like it's a big coil just being wound up, and at some point it's going to let go, but it's being held down by all this uncertainty and smoke that's going on right now. But at some point it's going to give, and the fundamentals are all pointing in one direction, and it needs to let go at some point. It's just a matter of when and how fast it's going to be.
Yeah, and maybe just to add on that, I mean, we've obviously heard from companies like Cameco in the last few weeks say they've basically stepped back from contracting because the utilities are expecting lower prices and they're not willing to budge. So it is starting to have an impact in terms of, that term market. We've also heard some stories about some of the development projects that are taking a pause here because the prices just aren't there to support the upfront capex to get these projects going. And that's the big challenge. And that's why we've been saying for several years now that the dynamics over the next 4 or 5 years look very positive, because we just don't see where this big supply response is coming from, given the long lead times to bring new projects to market and some of the what we believe are real supply chain challenges in Kazakhstan. If you've got a time horizon that's in the 2 to 4 year range, we remain really, really constructive. And I think one of the challenges is last year when the price of uranium broke 100, it attracted a lot of very hot transitory hedge fund money. We think that money is long gone. It's gone on to other things. It's chasing AI. It's chasing other things. It feels as though it has flushed through. And what was interesting at the Bank of Montreal conference was probably about 20 to 25% of our meetings were with institutions that we had met for the very first time, and we're still pretty early in their process of doing work. And I think maybe this pullback that we've seen in the last few months represents an interesting, entry point for those that missed the first part of the bull market. And the other thing I would say is, just like with copper, the producers are all saying we need a lot more production, but the production's not going to come unless there's incentive pricing. And right now, the price of copper does not reflect an incentive price at $4 and change per pound. And the spot price at 65 does not incentivize new developments unless you've got a really high-grade project somewhere. So we run the risk that this supply deficit situation will just become worse if prices remain too low for too long.
Well, it seems that patience will pay, and to your point, the kind of the hot money that drove the price up originally seems to be on to other things, and you're super connected to that narrative, that storyline, who's coming and going within the funds. Does it feel like to you then that the investor, the more long-term, patient investors are starting to sort of circle this narrative and look at it for the first time in a meaningful way. Is that your general sense out there, or are we still early with that?
Yeah, our sense after talking to obviously a large number of our existing institutional shareholders is, yes, they're confused and frustrated, but they're largely staying the course here in terms of focusing on the mid to long-term fundamentals, realizing the market's going through an air pocket here of uncertainty that's mostly driven by tariffs and trade policies and geopolitics, and that they're trying to look through that. And yes, it's not fun going through. The folks that we've talked to believe in the long-term thesis, and they largely, as I said, are staying the course. One of the questions we get on a regular basis is, what are the catalysts coming up that are going to change market dynamics? And, we've always said to people, it is a very catalyst-driven market, and they're very hard to predict because they're not schedule-based. They are very specific issue-driven, meaning all of a sudden the Japanese, for example, announce they're going to restart more nuclear reactors, or the World Nuclear Association puts out a new demand forecast. Like, those kinds of events have acted as catalysts to give market demand signals to investors to act on. It is kind of a lumpy market in terms of these price signals, and it's very hard to predict where they will come from. But historically, they always come. Some of them are supply-driven, some of them are demand-driven. You just have to be patient and wait for them, because the nature of this market is we go through air pockets where there isn't a lot of news flow, and everybody's just kind of wondering what next.
Well said, John. Any last parting thoughts before we sign off today?
I would just echo that, we are equally as frustrated with some of the price action we've seen on the spot side. We are doing our best to kind of look through that and focus on the longer term fundamentals, which have not deteriorated whatsoever. And yes, the trade dynamics are really creating a lot of confusion and uncertainty. But for investors that have more than a few weeks, which seems to be the norm today in terms of time horizon,
right?
Many investors, I think there's a very interesting setup here.
Gentlemen, it's always great to have you on Sprott Radio. Thank you for your insights and thoughts. We'll check in towards the end of the year and see where we stand. This is something I think a lot of investors are keenly interested in right now, of the directional moves in both the physical markets, but also the miners themselves. So thank you all for listening today. Once again, I'm your host, Ed Coyne, and thank you for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.